In this video, I'm going to show you exactly how to trade LEAPS call options profitably and how to retire off $100,000 doing so. Now, if you're someone who's never traded LEAPS options, this video is going to be perfect for you. It's a beginner tutorial. Now, if you're someone who has traded LEAPS options, but you haven't been able to generate enough income consistently through LEAPS call options, I'm going to show you exactly how to do it. Now, take a look at my computer right here. As you see, this is just one of my portfolios. We're logged in today, March 24th, 2025. By the time you're watching this video, it may be way later and it doesn't matter. I'm gonna show you strategies that will work in years to come. Now, as you can see, total gain today, $8,467. And a majority of this was from actually two LEAPS options or LEAPS positions that I had, okay? I had 3 Palantir LEAPS options that I entered last week. And then I had 6 Robinhood LEAPS options that I also entered last week. And I was up 3,280 on these and 3,981 on these. And I'm going to show you exactly how I was able to time my entries so perfect and how I was able to actually exit for big profits, over 40% in just 1 week. Now, before we jump into it, remember, this is not financial advice. This is just me sharing exactly how I've built wealth utilizing options. And if you do want to make 6 figures trading options, you decide that you need more help with this, click that first link down below in the description. We currently have 50 clients that are profitable trading with me, alongside me. And if you do have any questions throughout the video, you could either comment down below or go over to my Instagram or my free newsletter where I give away free trade ideas. Those are both down below in the links in the description. Now, let's go ahead and jump into it. What are LEAPS? Okay, LEAPS are long-term equity anticipation securities. Basically, it's either a call or a put option that expires in 365 days or more. Now, I don't usually trade LEAPS put options, so this video isn't gonna talk about that. That's typically stored for a bear market. But I'm going to be talking about LEAPS call options, okay? Especially because we are in a bull market right now. So the only type of options that I actually would buy because of the low theta decay or how much they actually decay every single day. So remember, when you buy a call option, right? You see people buying call options on fund stocks, trying to turn their money into, 3x, 5x, 10x. Those options are decaying in value every single day that goes by. So you have to be right directionally, and you have to be right in the designated amount of time that you are going out, right? If you buy a call option that expires in 30 days, you have to be right within 15 to 20 days, okay? Now, the only type of options that I would buy are LEAPS because it gives me enough time to be right, so 365 days or more on my favorite stocks, and they have less theta decay or time decay than a typical call option, okay? Now, I would do 70 to 80 delta. That's a sweet spot, and I'll show you what that means. Don't worry, we're gonna dive into the options chain. We'll go over all the technicals, but basically you get unlimited upside potential. So if the stock went to infinity, right, you could technically make infinity. So that's what's nice about call options, LEAPS call options, is that there's no cap to how much you can make. The leverage is usually around 3 to 1. So usually you pay a third of the price you would have to pay to own 100 shares. So you're controlling 100 shares of stock for a third of the price. So let's just say the stock was $100, right? $100 or 100 shares of that would be $10,000, okay? But you're gonna be able to control the same amount of shares for $3,000. So we'll dive into that as well, and I'll show you an example. But if you look at the chart to the right of me, you can see that you have a break-even point, which is how much you paid for that call option, which is what you could lose, right? If you pay, let's just say $2,000 for 100 strike price call option. So let's just say you bought a call option on NVIDIA. That strike price was $100 and you paid $2,000 for that $100 or that 100 strike call option. Your break-even is going to be 120, okay? It's really, you paid 20, but you have to multiply that by 100 because you're controlling 100 shares. So your break even by expiration in a year is 120. So NVIDIA has to be at or above $120 for you to actually make money or break even, okay? And then if NVIDIA 1 year is below 120, that's when you start losing money that you paid for the call option. But don't worry, I'm only going to show you how to get in an opportune moment so that you can generate consistent income with them and you can profit big with them to pay for, obviously, retirement and things like that. So let's go ahead and dive into, first I want to show you the backtesting tool this actually works, right? You see that it worked for me. I showed you my proof in my brokerage account, but let's actually use data to see if this actually works, okay? So this is a backtesting tool here on one of my other brokerages, Tasty Trade, and we're just gonna do this on QQQ, which is the NASDAQ 100. It's the index, right? And we're just gonna do the past 2 years, okay? We're gonna enter one contract, one LEAPS call option. We're gonna buy a call, one contract, 70 delta, that expires in 365 days. And then we're gonna press run backtest and let's see what happens. So as you could see, okay, your strategy, basically buying this LEAPS option, your total profit on that contract was 31,000. Return on capital was 151%, okay? Now, if you were to just buy and hold QQQ with that same, let's just say 100K, right? Your return on capital was only 57%. So on 100K, you'd only make 57,000 versus 150,000 you'd make with 100K utilizing the LEAPS option. So you could see that how you get that 3-to-1 effect with your money. You're basically leveraging up your money 3-to-1. So it's great, right? This is a good system that works. If you're buying LEAPS call options, I'll show you how to collect income on them. And this typically works in a bull market. So you have to know, are we in a bull market? Are the interest rates, going down? Are they being cut? Right now they are, right, in 2025. So we are in a bull market. We had a bear market in 2022 that didn't recover really to previous levels, which was like December 2023 or January 2024. So we had a massive bear market and now we're in a bull market. So this strategy works during those times. Now let's go ahead and jump into exactly when to enter to guarantee income, and then also, guarantee that you're going to be getting good prices on your LEAPS call option. So number one, all right, you can make a lot of money with this if you get into a good stock with a good chart and good PE ratio, okay? Those are two things, two fundamentals I'm gonna give you. You don't have to dive into the technicals and the balance sheet and all that for the stocks. You just have to make sure that they're good stocks, they have a good upward trending chart and a good PE ratio. So I'm gonna show you two examples, okay? First, we're gonna look at Robinhood, okay? Robinhood. And then we're gonna compare it to Charles Schwab. So these are two companies that are basically in the same sector of financial brokerages, right? You could trade stocks with Charles Schwab, you could trade stocks with Robinhood, right? Two companies, same sector. Charles Schwab is actually a bigger company. They've been around longer, okay? But we're gonna take a look at the charts, okay? We wanna make sure that the charts are upward trending. Now, if we go back 365 days, this is Charles Schwab. This is the ticker symbol SCHW. This stock has done nothing for the past year, right? We are at the same prices as 1 year ago, okay, on this particular stock. So that is not a good thing, especially with LEAPS options, LEAPS call options. You want the stock to be going up, okay? So this is a good example of, hey, the stock, fundamentally is good. It has a good PE ratio, which, the average PE ratio of the S&P 500 right now is between 26 and 28. It fluctuates, but that's kind of the S&P 500 average of the top 500 companies, right? So 26, anything below that is a good PE ratio fundamentally from a valuation perspective, okay? This company has 25, so this is better than the S&P 500, right? If we look at Robinhood, the PE ratio is 28, so it's a little bit higher, right? Charles Schwab has a better PE ratio, but Robinhood has a higher PE ratio. So how is Charles Schwab not trending upwards versus Robinhood? Okay, this is what Robinhood has done in the past year, okay? In the past year. As you can see from all the way back here, we are much higher, okay? This stock was trading at $17. Now it's trading at Mind you, it went through a huge crash. It was trading at 65, but it's trading at $48 from 17. So this stock has nearly tripled from where it was last year, yet Charles Schwab hasn't done anything. So we want to make sure that the stock we are choosing has high growth potential. And how you look at that is you look at the chart. The chart tells you, paints a really good picture of what investors feel about the stock. So people like Robinhood. They like how the company is performing. It does have good PE ratio, not as good as Charles Schwab, but there's more growth ahead of Robinhood because they cater to a younger demographic, the upcoming demographic that's going to be inheriting a lot of money, and they make trading easy. So this is a very good stock to choose, all right? Now we got that out of the way. We have a good chart, good PE ratio, the chart's trending upwards. Now when do we enter our actual LEAPS option? So we're gonna go to the options chain, and I'm gonna go to Robinhood just so we have a good example, okay? What I like to do is, like we talked about in the previous slide, we go 365 days or more. So we could go, to the March 20th, 2026. I know it's 361 days, but we'll just round up to 365 since that's only 4 days away because the next expiration is 662 days out. That's fine. You could go 2 years out or almost 2 years out, but we're just going to do this one for example, okay? Then we're going to choose the 70 delta. There is no 70 delta. They either have a 75 or a 69. We would go to the 69. And what that means is that for every dollar that Robinhood goes up, you would make 69 cents. And this number will go up as the stock goes up and this strike price gets deeper in the money. As you could see, like the 25 strike price LEAPS option has an 89 delta because it's so deep in the money. So every dollar that the stock now goes up, this call option is making 89 cents per dollar, okay? So this is the one I would select, the 45 strike, 69 delta, and I would pay about $1,485, $14.85 times 100, $1,485, okay? To control 100 shares, which would typically cost you $4,800 because it's currently trading at $48 right now, okay? So you are literally trading 100 shares for a third of the price, even less. All right, so that's the one I would choose on Robinhood. Now, let's talk about theta decay because you might be wondering, well, Ryan, if you think the stock's gonna go up, why wouldn't you just go out, 30 days and buy a call option like most people do? Well, if you look at the theta decay of that 70 delta, 45 strike, this is decaying at $6.20 per day. As you can see, 0.06 is $6 if you multiply that by 100. $6.20 versus this LEAPS option, the 69 delta, 45 same strike, is only decaying $1.80 per day, okay? So this one is decaying slower every day that goes by, and you have more time to be right, okay? Because if for some reason the stock doesn't go up and within 30 days, right, your option may expire worthless because this number is going to grow as the time gets closer to expiration, okay? So that's why I choose a year out or more and I go 70 delta, all right? So that's that. Now let's talk about when to enter, okay? Is it a good time to enter a Robinhood LEAPS option? Well, what I like to do is look at the VIX, okay? The VIX should at least be above 15. The VIX is the fear and volatility index. So we can go to the VIX, all right? And basically what this is it measures the fear in the S&P 500 options, okay? When this thing is above 20 and climbing, that means there's a lot of fear and most likely there's going to be a crash. As you can see right here, back on August 5th, we had a huge crash. I'll go to QQQ. As you can see, the stock crashed all the way, negative 15% on August 5th, okay? And when this thing goes down, when the VIX goes down, right, the stock market goes up. So as you can see, that was the last day, August 5th, and then the market went up and the VIX went down. So this gives us a good reading of fear and when there's an overstatement of fear, because fear is always overstated and it always comes back down to greed, okay? Just like here, we had a crash recently. VIX didn't go as high as this. It did go up to 30, almost 30, and now it went back down, and the market, basically did the same thing. Okay, went all the way down, and now it's going back up. Okay, so I like to look at the VIX to determine when to start getting in. You want to get in when people are fearful, not greedy. When the VIX is down here, like at 12, 11, between 10 and 15, people are really, really greedy, okay? And the market tends to just melt up. But what you have is a situation where any bad headline, any bad piece of news can send the market tanking downwards, and you bought your leaps at all-time highs, and now you're going to lose 50% of your money in value on those leaps options, and you don't want to be in that position, okay? So I like to buy leaps when the VIX is high, fear is high, so I get good entries. That's how I got good entries on the Palantir leaps and the Hood leaps, because the VIX was up here last week, about 24, 25, way above 15, and now the VIX is all the way down at 17, and the market has rallied a bit, okay? So these are the waves. You could, if you want to screenshot this and pause so you could write this down, you can enter in waves if you'd like. You don't have to put all your money in at once. You could wait for the VIX to be between 15 and 20, and then maybe keep a third of the cash for when VIX is between 20 and 25, and then another third between 25 and 30, like what happened on the chart right here, right? We started off, the VIX was at 15. You enter your leaps position. The VIX got to 20 and it went to 25. You enter your next third and you enter your last third when it goes above 25. Now, are you always going to be able to catch it like that? No. So what I like to do is just, enter twice, just maybe half on a red day and another half next week on another red day. That's just the first criteria, okay, is the VIX, understanding the VIX and the VIX level. So if you need to pull that up on your TradingView account, pull up the VIX so you can take a look at how it performs and behaves with the stock that you're going to trade. The third is having the stock near the lower Bollinger Band. So we do like to enter when the VIX is higher and the stock is lower near the lower Bollinger Band. So we can look at VIX, all right? We're above 15 right now, so technically it would be a good time to enter a leaps position. And we'll look at Hood, okay? And Hood has already went up quite a bit. We're almost near the upper Bollinger Band. So if you click on indicators and type in Bollinger Bands, okay, you're going to click on that and pull that up. Basically what these are is these tell us that the upper band and the lower band are 2 standard deviations away from the average price of the stock, or basically saying that the stock will stay in between those 2 bands and 95% of the time. And then 5% of the time, the stock might breach those bands. And that happens. As you can see right here, this was a 5% move, outlier move, right? 5% on the lower Bollinger Band. And when the stocks are at extremes, meaning the upper or lower extreme of the Bollinger Band, this is a good time to get into a leaps option. Now, I would get into a leaps call option when the stock is near the lower band, okay? So this would not be a good opportune time for Hood, for Robinhood. Yes, VIX is above 15, right? But Hood is near the upper Bollinger Band already, and that is not a good time, because what can happen is the stock could touch that upper Bollinger Band and then crash back down to the lower. We want to get it when it's at the lower. So let's take a look at a different stock. I would say Amazon or maybe even Google would be a better option here, okay? Let's just look at Amazon, all right? Amazon is like right at the middle line of the Bollinger Band. Is it optimal? Is it the most optimal entry? No, it's not the most optimal, but if you look at how far the stock has dropped, this would be a good time to buy. We're not near the upper Bollinger Band, that's for sure. The upper's at 215, the lower's at 187. We're kind of right in the middle. So this is technically a decent entry for a leaps call option. All right, we're about halfway, and as far as all-time highs, we're a long ways off, okay? We're a long ways off. So what I would do is I would get into a leaps option on Amazon because the VIX is high, it's near the lower Bollinger Band, and near all-time lows of the year. So this would be a good opportunity to get into that, all right? So that's going to be kind of entry for your leaps option. Now we could go to Hood, or actually we could go to Amazon and, we could participate in this. I'll show you how to do it. So we will go out 365 days And we'll go to the 70 delta. We'll just go to the 71 delta, pay 3,900 bucks for the 185 strike, okay? That's gonna get you all the way down here. Basically, your call option is gonna be all the way down here. And worst case scenario, okay, is you get assigned the stock, okay? If you have enough capital to buy 100 shares of the stock, then this call option, just look at it as a placeholder, okay? You could either get assigned the shares at 185, even if the stock is trading at 250 and you never decided to close out the call option, you could just get assigned the shares at 185 and you'll own those shares all the way down here, right? But I don't usually do that. I usually close out at a profit. So that's gonna be the next topic, is when to exit, all right? So there's 3 different ways you could do this. Number 1 is you exit at 20% to 50% profit in 14 days or less. That happened to me on Palantir and Robinhood, those LEAPS options that I had. I was up 40%. So I said, you know what? It hasn't even been 2 weeks yet. I'm just gonna take my profit and run with it. Sometimes I have to wait for 3 months before I see 50% profit or even 20% profit, right? Sometimes the stock doesn't move for a while. So if you get that quick profit, I would take it off the table, and you could always get back in the next time the stock crashes, okay? Because it's bound to happen, happens multiple times a year, right? If you look at Amazon, you know, throughout the years, you know, there's one crash here, one crash here, one crash here. Every 3 or 4 months, you're gonna see a nice pullback on the stock, okay? So that's number 1. Number 2 is to set price targets. So to give you an example, all right, I do have still have some Palantir LEAPS options, the 80 call options that expire in 361 days. I have 5 of them. I'm up 12%. And I've had these for about, 2-3 weeks now. The entry wasn't perfect, but it met the criteria. VIX was above 15. Palantir was near the lower Bollinger Band. I'm up to almost 2,000 bucks on these. But when am I going to exit these? Okay, so for me, okay, I set different price targets. So for Palantir, I already have my price targets set out. We're here. My first price target is 101. That could be a potential exit for me. Maybe half my position, I exit there. The next is going to be 108, and possibly I leave one last one for 116. Okay, so you want to have these kind of price levels drawn out. I usually use kind of support zones and resistance zones where the stock has previously traded before, okay? So as you can see, like the candlesticks, the stock has traded at this level before, at this level, and at this level many times. So I just like to have those price targets in my head. You should have your price targets and stick with the discipline of exiting your trades when those price targets are hit. Don't just keep holding and wishing that the stock's gonna keep going up, okay? So I like doing that. And then number 3, if you're building out a long-term position, you can kind of have that discipline of saying, I'm gonna keep these LEAPS options for the whole year. I'm just gonna start adding on every dip. Every time that the VIX is up and the stock comes down to the lower Bollinger Band, I'm gonna add 2 more, right? 2 more. And you build a position up for over a year, and then in year 2, you could start unwinding that position and taking them off. I've never personally done that, but I know people that have done that. It's a very long-term approach, and it could be very, you have to stomach some volatility, but that could also be another strategy that you utilize, okay? So that's when to exit. Now, let's talk about generating income off the LEAPS with covered calls. This is a little bit more advanced, and you have to be careful with this because when you sell a covered call, you're basically selling a naked option against your LEAPS. And if that option becomes in the money by expiration, your LEAPS will get called away. So the brokerage will close out your LEAPS automatically. And maybe you don't want that, right? You don't want that because you're planning on holding the LEAPS for longer. So you have to be careful with this. So what I like to do is enter when a stock is touching the upper Bollinger Band on the daily time frame. 30 days out to expiration. If tested or in the money, roll up and out 40 to 60 days max to cover loss with some profit. So what happens is, let's just say we own that LEAPS option at 100. I sell the 105 call against it because I think that the stock's not going to go above 105. If it doesn't, I get paid my 500 bucks or whatever I collected from that call option as income. And if it does go past it, then I'm at a loss. So I will have to close this out at a loss and roll it up or open up a new position to cover that loss, okay? This is a very more advanced strategy. So if you get a little lost here, don't worry about it. I have a full tutorial down below, like on options, but I'm gonna briefly go over this. So let's just use my Palantir Leaps for, we could use my Palantir Leaps as an example, okay? I have these 80 calls already up on them. So this might be a good time to sell some covered calls for income. All right, so I could go to the options chain and I will go 30, let's just go 32 days out. And I could go all the way out to the, to be safe, I would do a 20 delta, okay, to not get tested. This is the best strategy if you just don't want to have to get tested or have to manage the position as much. I could go out to the 20 delta, collect 164 bucks per contract, okay? And I could sell 5 of these. So that would be, over 700 bucks because I have 5 contracts. I could sell 5 calls against my contracts. And this is all the way up here at 115. So this is actually something that I may do. And 115 is all the way up here. So the chances of Palantir going all the way to 115 in 30 days is very, very slim, right? There's a 20% chance as per the delta, right? We're selling a 20 delta. So this is a 20% chance of being in the money. So the lower this number, the less the chance of it being in the money and you getting tested. Ideally, you'd like these to expire worthless, meaning the stock is below 115. By expiration, you just let them expire and you collect your whole premium, okay? So that is something that you can do to collect a little bit of covered call income. Just know the risk behind it. The risk is you might get your leaps called away if you don't manage the position, okay? So yeah, that's for another video. I do have a video on rolling options, but that's how to generate income every 30 days off your leaps with covered calls. All right. Now let's go ahead and talk about 3 stocks to enter leaps on. So these are stocks that I believe still have opportunity to run for leaps. I know we talked about Robinhood being a little bit closer to the upper Bollinger Band, not the most opportune, but in regards to where it's at from its all-time highs, okay, I still think there's good risk to reward here. From all-time highs, we're still 27% down. So in the next 365 days, I do think that Robinhood will be above 57, probably in the mid 60s range, okay? So right now this would be the least opportune one because it is a little bit closer to the upper Bollinger Band, but the VIX is still high and this stock is way down from all-time highs. So I do believe this is a good option. Now, which one would I choose? Okay, I would go out to Hood, go to the options chain. We'll go to next year, 361 days out. And yeah, I would just go for that 69 delta, pay $14.85 for it, and just hold and let this thing run up, okay? That's the first one. The second one is going to be SoFi. This is actually one of the most opportune and I believe the safest play because yes, we are, approaching the upper Bollinger Band here, but VIX is still high. But overall, we're very low from the all-time highs. We're about, 25% discount. And this is a pretty safe company with a lot of good investor sentiment behind it. So this would be a good one. And, for someone that doesn't have as big of an account, these ones will be a more affordable. This will be a more affordable play, okay? So you can go to the options chain. Again, you go to March 20th, 361 days out. I'll just round up to 365. All right. And, we would go to there is only a 67 delta or an 81 delta. I would probably go to the 67, which would be the 13 strike. And you'd pay 380 bucks for this one. So this one is good for someone who has a smaller account but wants to play a good company that has a lower share price, okay? Good valuation still. It's still a relatively cheap company because of valuations, but the stock price is also low, which is good for small accounts, okay? So that's gonna be probably my favorite one that I will potentially get into if we do see SoFi down in the next couple weeks, okay? And then the last one is gonna be Palantir. This is gonna be my highest risk play, but it does have a lot of upside potential in the long term, all right? So This one is at the upper Bollinger Band, but that's because implied volatility has came in quite a bit. I do believe that the stock has a lot of room to run. If you see from all-time highs, we are currently down 22% on this one. So this would be the highest risk play because we are near the upper Bollinger, or we're actually touching the upper Bollinger Band. Okay, I would wait for this to kind of come down a little bit, but it has a lot of upside potential as far as previous all-time highs on the stock. Okay, and I'm still in these ones, so I would only practice what I preach. I'm still in these. I have 5 of them, and I'll wait until this stock pops up even more. So if you enjoyed videos like this, please give it a thumbs up. Make sure to subscribe, and I'll see you in the next video right here, which is going to be the wheel strategy on my favorite stock to generate income every single month consistently, passively, and guaranteed. So check that video right there, and I'll see you in the next one. Take care.